In recent months, something absurd and downright terrifying has been unfolding across the entire precious metals market. COMEX lost 37.6 million ounces of silver in just 47 days. South Korea, one of Asia's most stable financial markets, suddenly halted physical silver sales indefinitely. Many European banks did the same, and across the United States, major dealers are hanging sold-out signs on products that were always in stock just last year. But here's the mind-blowing paradox. The spot price of silver still hovers around $25, $30. Yet the price real buyers actually pay for physical silver has rocketed to $70, $80, even touching $90. So why is the spot price low while the real price is shooting to the moon? The answer isn't that the price is rising, it's that silver is disappearing. When you trace the inventories, follow the supply chains, and watch banks retreat from the market, you start to see a chilling truth. Physical silver is no longer freely circulating. The system is sealing itself off, layer by layer. Backwardation, the telltale sign that only appears when a market is in panic, has become the new normal. Buyers are willing to pay far more for silver right now than for delivery in the future, because they no longer believe in that future. This isn't speculation. This is market data. Deliveries are stalling. Banks can't restock. Industrial demand is surging so fast, it's swallowing global inventories. And once you look straight at what's happening, you realize the window to buy silver below $100 isn't an investment opportunity. It's the signal of a system entering the squeeze phase, where physical silver becomes an irreplaceable and unobtainable asset. Throughout U.S. financial history, silver has always stood alone as the only metal that straddled two worlds, the foundation of money and the irreplaceable raw material of modern technology. To understand why the sub-dollar 100 window is closing so fast, you have to recognize a pattern that is repeated for centuries, a pattern as simple as it is brutal. The four-stage cycle. Stage 1. Establishment. This was the era when silver was treated as the backbone of the American monetary system. From the late 19th century through the mid-20th century, silver coins weren't just a medium of exchange, they were the nation's stability standard. Every dollar could be directly redeemed for silver at a bank. Americans grew up believing money had value because it was tied to real metal, tangible wealth no government could print at will. That stability lasted decades and created an almost instinctive belief: silver = real money. Stage 2. Manipulation. When the U.S. removed silver from coinage in 1965, a new door opened, not for the public, but for Wall Street. Once silver was no longer monetary backing, financial institutions started creating paper silver, futures, options, ETFs, and a flood of derivatives that let traders control hundreds of millions of ounces with nothing but numbers on a screen. From that point on, one physical ounce could be leveraged into 20, 50, even 100 paper contracts. The phantom supply diluted the market, artificially suppressed prices, and convinced investors silver was always plentiful. A dangerous illusion because the paper market never required actual metal to back it. Stage 3. The squeeze. This is when the system starts strangling itself. When buyers no longer want promises but demand real metal, everything breaks. Vaults empty, registered silver inventories crash, and major dealers post sold-out signs. What we're seeing today, banks halting sales, Asia restricting transactions, premiums soaring far above spot, isn't an anomaly. It's the classic signature of Stage 3 in every historical cycle. Physical demand overwhelming real supply. Stage 4. The break. This is the moment the paper market can no longer hide the truth. Real silver is gone. When the mountain of contracts can't be settled with metal, futures are forced into cash settlement, ETFs can't guarantee backing, and the entire spot pricing system becomes meaningless. Only the physical market, where price reflects actual scarcity, remains to determine silver's true value. And this is what makes silver completely different from every other metal. It isn't just a defensive asset like gold, it's the lifeblood of modern technology. EVs need silver, solar panels need silver. Batteries, chips, sensors, medical devices, 5G military radar, guided missiles, all need silver. Industrial demand is growing exponentially, while global mine production has been negative for years. That makes every physical ounce more valuable than virtually any other asset. When a metal is simultaneously money, the foundation of technology, and in structural deficit, a squeeze isn't a possibility, it's a certainty. And that's exactly where we stand. Deep in Stage 3, on the doorstep of Stage 4, as each physical ounce begins breaking away from the spot price and moving toward whatever the real market is willing to pay. Under $100 isn't a price target, It's the final window before the physical market reprices silver at its true value. In every precious metals crisis, history leaves the same eerie fingerprints. When real silver starts vanishing and physical demand spirals out of control, the system always does exactly three things: change the rules, halt trading, and restrict public access. This isn't theory. It's fact that is repeated at least 3 times in the last century. Start with the most famous example: the Hunt brothers in 1980. Two Texas oil billionaire brothers, Nelson Bunker and Herbert Hunt, believed the dollar was dying after the U.S. abandoned the gold standard. They did what central banks do today. They accumulated real silver, not a few tons, over 200 million ounces, half in physical metal, half in futures with physical delivery demanded. As silver surged from $6 to nearly $50 in a single year, what collapsed wasn't the market, it was the system's cover-up. COMEX panicked, not because the price was rising, but because they knew the actual silver in their vaults was nowhere near enough to honor all the paper contracts. So they did what every paper system does when cornered: they changed the rules mid-game. Silver Rule 7 banned new long positions. Margins were jacked up overnight. Paper players were squeezed, forced to sell, crushed. The price crashed from $50 to around $10. The Hunts went bankrupt, but one group walked away unscathed: everyone who held physical silver. That's history's first lesson. When the paper market implodes, the metal in your hand doesn't lose value. Next is a lesser-known but hugely relevant example about outright bans on selling: the silver requisition during World War II. When America entered the largest war in human history, the military needs for electrical conductors, weapons, radar, and hundreds of other applications exploded. The government ordered the seizure of hundreds of millions of ounces from vaults and even from civilian industry. Factories were forced to stop using silver. The public lost normal access to supply. This was the moment the free market was simply shut down, not because of price, but because the government declared silver a strategic national resource. Remember this: in true shortages, governments don't just change rules, they can completely ban civilian sales or use. That's not a hypothesis. It happened, and it shows one truth: when a nation needs silver to defend itself, civilian market demand gets pushed aside. The third example proves the pattern applies to any metal with real backing: the 1971 gold window and the 2001 palladium shock. No longer had enough gold to honor foreign dollar redemptions. Nixon did the only thing he could to stop gold from draining out of the country. He slammed the gold window shut. An 18-minute speech ended the ability to exchange dollars for gold, an outright international ban on selling gold in the purest sense. When physical backing runs out, the system sacrifices transparency to survive. And in 2001, the story repeated with palladium. Russia, the world's largest palladium producer, abruptly halted exports. The paper market kept trading as if nothing happened until futures expired and buyers demanded physical delivery. There was no palladium to deliver. Price soared 263%. Paper traders got burned. Physical holders won. All three examples: Hunt Brothers, 1980, WWE, silver restrictions, gold window 1971, and palladium 2001, tell the exact same story. Whenever a precious metal becomes scarce, the most powerful players in the system do 3 things: change the rules, shut down markets, restrict or outright ban the sale of real metal. This isn't conspiracy, it's math and history. And it leads to the unavoidable conclusion: if everything happening to silver right now, banks stopping sales, inventories evaporating, governments tightening transactions, looks exactly like stage 3 of the 4-stage model, then what comes next won't be a gentle correction. And when you look at the present, there's no more guessing or theorizing. Every stage 3 signal is flashing simultaneously, unmistakably, overwhelmingly. The strongest proof is where this pattern always reveals itself first: COMEX. For years, COMEX operated on one assumption: only a tiny fraction of contract holders would ever take physical delivery. But starting late 2023, and especially throughout 2024-2025, that assumption shattered. Registered silver, the metal actually available for delivery, has plunged from relatively stable hundreds of millions of ounces levels to numbers that make any expert's blood run cold. Some days COMEX lost nearly 10 million ounces in 24 hours. Withdrawal rates are running 3-5 times normal. This isn't profit-taking or rotational demand. This is a silent bank run on physical silver, visible only to those who watch the vault data. And when inventories drain, the entire futures-based pricing structure starts to wobble, because the paper only has value as long as people believe real silver is still sitting in the vaults. But it isn't there anymore. Next is a signal never before seen in modern times. Major banks are pulling out of the physical silver market. South Korea is the poster child. 4 major banks simultaneously suspended physical silver sales with no resumption dates TBD. Not because demand dropped, because they literally can't source metal to meet it. In China, new restrictions make it far harder for citizens to buy precious metals through bank channels. That matters because when China tightens public access, it almost always means the state is hoarding. At the same time in the US, major dealers are posting out of stock on countless silver bars and coins. Some dealers report premiums so high they won't even list them publicly. This is what banned from selling really looks like. Not a legal decree, but the brutal reality that banks and dealers have nothing left to sell or can't source it at any sane price. Once the financial system can't deliver physical silver, the market has effectively entered a de facto sales ban. The third and most powerful signal is backwardation, an extremely rare phenomenon in silver, but the single most accurate indicator of panic. When spot is higher than futures, it means one thing only. Buyers no longer trust the future. They want metal now, at any cost. Historically, backwardation has only appeared during severe physical shortages, and every single time stage 4 was right around the corner. The market is screaming to anyone who will listen. Real silver matters more than promises of future delivery, but what finally wakes most Americans up isn't backwardation or vault drains, it's the premium shock. They see spot at $25, $30, and think, not yet. Then they visit major dealer sites and get hit with reality. Silver Eagles, $50, $60, Maple Leaves, $40, $50, small bars, over $70, and secondary market deals already touching nearly $90. Spot didn't move. Physical shortage detonated the premium. When spot is $25, $30, but physical silver costs $70, $90, then $100, physical silver isn't a bold prediction anymore. It's the natural next step the moment stress increases just a little more. Even a mild squeeze is enough to push premiums up another $20, $30, and that squeeze is happening right now. Yet the deeper reason physical silver is vanishing lies in the global supply-demand structure. A point many American investors still haven't fully grasped. Silver isn't just a hedge asset, it's a critical industrial raw material. From EVs to solar panels, energy storage batteries to medical sensors, chips to military equipment, every technology the modern world depends on is devouring silver at an ever-accelerating rate. The solar industry alone now consumes over 12% of total annual global silver supply, and that percentage is rising fast. Meanwhile, worldwide silver mine production has been declining for years in a row. While gold can be recycled at high rates, silver is permanently consumed. A huge portion ends up in electronics where recovery costs are prohibitive, meaning it's gone from the market forever. Starting around 2030, many research institutes forecast silver will become a strategic resource on par with rare earth metals. And once silver becomes strategic, every nation starts stockpiling. India is importing record amounts of silver. China is buying at a massive pace to feed its solar industry and state reserves. The BRICS bloc wants out of the USD system and is accumulating physical precious metals, never a good sign for anyone holding paper assets. When the biggest nations hoard silver, it means one thing. Ordinary people will have less and less access to physical metal. Put all these pieces together: empty vaults, banks retreating, backwardation, exploding premiums, nation-state accumulation, and you get the complete picture of stage 3. This is no longer speculation. It is a perfect one match with the squeeze phase of every recorded cycle before stage 4. The crucial point is that stage 3 never lasts long. It is the shortest phase of the entire model. The moment the market realizes real silver is gone, stage 4 arrives so fast almost no one has time to react. And when stage 4 hits, price ceases to matter. The only question left is, do you have real silver or not? And when every stage 3 signal is already this obvious, the question is no longer whether stage 4 is coming, but how it will arrive. Stage 4 has always been the most brutal phase of the entire cycle because that's when the truth the system tried to hide is suddenly exposed to everyone at once. Real silver is exhausted, and the entire paper market can no longer function normally. The first thing that always happens in stage 4 is sudden trading halts. Exchanges will announce technical issues, system overload, emergency maintenance, liquidity problems, but there is only one real reason: there isn't enough silver left to preserve market integrity. And when trading halts, most people think they've gained extra time to prepare, but in reality they've just lost their last chance. The next step is forced cash settlement. It happened with palladium in 2001, nickel in 2022, and every other asset when physical supply was choked. If the exchange can't deliver actual metal, they force buyers to accept cash instead. With futures, that means your contract, marketed as physically backed, becomes nothing more than paper. ETFs are no better. Most major silver ETFs state clearly in their prospectuses that they reserve the right to cash settle if physical metal cannot be sourced. In other words, you don't own silver, you own a promise to pay if demand doesn't get too crazy. But when stage 4 arrives, demand always overwhelms the system, and those promises turn into dollars right when the dollar is losing value fastest. Meanwhile, physical dealers go completely sold out across the board, not because they don't want to sell, but because they can't get metal from upstream. This is the phase when every investor finally understands that spot price has nothing to do with the real market price. Spot becomes just a number on a chart. Physical is the only price that matters. That's why $100 is not a ceiling. It's the final window before silver enters exponential repricing. When spot is $25, $30, but premiums are already $40, $60, the physical market is already valuing silver at $70, $90. One more mild squeeze, one big withdrawal week, one new trade restriction, one missed shipment, and premiums jump another $20, $30. The moment the market accepts $100 to get real silver, it doesn't mean silver has topped. It only means buyers have finally realized the spot price is wrong. The true price of silver is not the number on the futures market. It's whatever physical buyers are willing to pay when supply disappears. History has repeatedly shown the gap between spot and physical can widen to unimaginable levels. In past squeezes, physical has traded at double, triple, even 5 times the spot price. No one knows the limit, because once panic sets in, the only rule is whoever has real silver sets the price. As for when stage 4 will arrive, no one can call the exact day, week, or month. But the logic of the pattern is always right. Stage 3 is the shortest phase, and we are already deep inside it. Every passing month, vaults drain faster, premiums climb higher, nations hoard more, banks sell less. The sub-$100 window isn't closing overnight, but it's shrinking faster every week, and at some point it will simply vanish without warning. When stage 4 hits, your only choice will be to pay whatever the physical market demands, if you can even find any. And this is where everything comes back to your own decision. Act now or stand by and watch stage 4 roll in like a wave you can't outrun. The first thing you must understand is the absolute difference between owning physical silver and speculating. Buying futures, ETFs, or any paper contract means you own a promise. Owning physical silver means you hold the very metal the market is desperately seeking. The only asset that cannot be halted, cannot be cash settled, cannot have its rules changed by anyone else. One physical ounce in your possession has real value. One paper ounce only has value while the system is running normally, and in stage 4 nothing is normal. For American buyers, the safest and most liquid forms have always been globally recognized products. American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics, or 1Os, 10Os, and 100Os bars from reputable refiners like JM Bullion, Royal Canadian Mint, Asahi, Perth Mint. You don't need collectibles, numismatics, or special products with absurd premiums. You need pure, recognizable, easy-to-verify metal. As for allocation, this is not financial advice, but during periods of instability, many experienced investors keep 10-20% of their wealth in physical precious metals as insurance against systemic risk. You have to assess your own risk tolerance, but the key mindset is balance. Don't go all in, and don't sit out completely. This phase demands both caution and decisiveness. Above all, you must control where your silver is stored. If you keep it in a bank account or any system where someone else holds the keys, you are recreating the very risk you're trying to avoid. A home safe, private vault, or anywhere you have direct access is always safer. The sub-$100 window is closing, not because the price is skyrocketing, but because the physical market is draining faster than any forecast predicted. This isn't a prediction. This is data. And the question now is simple. Will you wait until stage 4 arrives and wish you had understood the pattern sooner, or will you act while there is still time? Subscribe to the channel right now so you don't miss any part of this series. See you in the next video, where the truth goes even deeper.